Dubai's booming real estate market offers attractive tax-free investment opportunities. In recent years, Dubai developers like MR, Damak, Sobha have launched flexible payment plans to lure foreign buyers. But as a buyer, you'll want a clear plan for financing, understanding developer payment plans, bank loan rules, and smart strategies. In this video, we break down everything you need to know about Dubai payment plans and mortgages for non-residents, from who can lend you money to key tips and examples. Let's get started. First, let's look at the payment plans offered by the developers in Dubai. Dubai's builders typically offer structured payment plans, so you don't pay 100% upfront. Common models are 50-50, 60-40, 70-30, etc. For example, under a 50-50 plan, you pay 20% upfront at the booking within a month, 30% of the price during construction, and the other 50% on completion. A 60-40 plan means 20% on booking, 40% during the construction, and 40% at handover. Each payment structure balances upfront versus later payments. For instance, Imar often takes 20% on booking, 60% in stages, then 20% on handover. Dubai developers also offer post-handover extended plans. For example, Samana developers let you pay just 1% of the price per month for several years. In one of their projects, buyers put 20% down, then pay 1% per month for 42 months, plus 0.5% per month for approximately 4 years after handover. This 1% monthly plan spreads 100% of the cost over 8 years, easing initial cash flow. While these keep early costs very low, remember, the title deed won't transfer to you until fully paid. Loan eligibility for non-residents. If you are a non-resident or foreign investor, it's important to know this. UAE banks generally do not finance off-plan properties, that is, properties that are still under construction. While the Oqood system is used to officially register your off-plan purchase with the Dubai Land Department (DLD) and serves as proof of your ownership interest, it is not the same as a title deed. Banks typically require the final title deed as collateral, which is only issued after the property is completed and handed over. So until then, you will need to self-fund all developer installments, usually 40 to 50% of the total cost using your own resources. Major UAE banks do offer mortgages to foreign investors, but the rules are stricter. For example, banks such as Emirates NBD, Mashreq and HSBC do have expat non-resident mortgage products. Local Dubai banks also cater to foreigners, often via Dubai branches. These lenders typically demand higher down payments from non-residents, commonly 30% or more, compared to UAE residents. Banks also set loan-to-value (LTV) caps. For completed properties, UAE nationals can borrow up to 85%, expat residents up to 75%. For non-residents, LTV is often lower. Many banks offer 50-70%. For off-plan purchases, LTV is generally limited to 50% once construction is near completion. In short, as a foreign investor, you will typically need to self-fund at least 50% of the property's value. Let's look at the bank loan process. Whether you finance with a mortgage or a developer plan, planning is key. First, get pre-approval to know your borrowing capacity. Approach a bank with your income documents to obtain a pre-approval letter. We at Remax will help you in this entire process. This usually takes a few working days. Banks will assess your salary or business income, credit history, and existing debts. They will also review the property. It must be in a bank-approved project. If you're borrowing for an under-construction unit, steps are: make sure the developer is on the bank's approved list. Tier 1 developers like MR, Nakil, Damak are usually okay. Submit passport, bank statements, salary certificate, or business license and audited accounts, etc. Banks typically require you to pay at least 50% of the price before they disburse any funds. Obtain a no objection certificate from the developer to let the bank disburse payments for the property. Once the above are done, the bank will release loan funds. The process is more straightforward to borrow for ready to move or resale property. Secure pre-approval, then sign the sales and purchase agreement. Pay a booking deposit, usually 10 to 20%. Submit remaining documents like valuation report, insurances, etc. to the bank. Bank approval and loan offer. Once approved, the bank issues a mortgage offer letter. Mortgage registration. On transfer day at the Dubai Land Department, your property is handed over directly to the bank in return for the loan. There is a mortgage registration fee of 0.25% of the loan amount. In practice, the whole mortgage process often takes 2 to 4 weeks if all paperwork is ready. You work with a lawyer to handle contracts and DLD formalities. Any bank processing fee, often 1% of loan, and valuation fee of around 3,000 dirhams are payable. But many banks offer promotions waiving some charges. Regarding rates and terms, interest rates can be fixed, locked for 1 to 5 years, or variable. Current home loan rates for expats generally range 4 to 6%. Emirates NBD's packages start around 4.49% fixed. Loan tenors go up to 25 years. Some lenders offer up to 30 years, depending on age. Banks also require life or credit insurance on the mortgage. Let's have a quick look at the list of documents needed for a bank loan when buying real estate in Dubai as a non-resident. If you are a business owner living outside the UAE, these are the documents you will typically need to submit. Start with your valid passport and your business registration documents such as a trade license, GST certificate or incorporation proof. You'll also need audited financial statements for the past 2 years to show the financial strength of your business. In addition, you must submit your personal and business bank statements, usually from the last 6 months, along with your most recent income tax returns. A credit report is also required. This could be your CIBIL score or an internationally recognized equivalent. You will need to provide proof of your down payment, such as a savings or fixed deposit statement. And of course, don't forget the signed sales and purchase agreement for the property. If you already have any loans or financial liabilities, include those documents as well. If you are a salaried employee, here's what you'll need. Start with your valid passport. Then provide an employment letter or salary certificate that confirms your job title, how long you've been employed, and your monthly income. You'll also need salary slips from the last 3 to 6 months, along with your personal bank statements from the same period. Your income tax returns and a credit report are also required. And just like business owners, you must show proof of down payment funds, such as a savings statement. A signed sales and purchase agreement is essential. Being well prepared with all the right documents can help you avoid delays and get your mortgage approved faster. There is also another payment plan called post-handover payment, popularly known as the 1% payment plan. Let's understand what exactly this post-payment plan is and how it compares to taking a bank loan. In a post-handover payment plan, the developer allows you to pay a small portion upfront, typically around 15 to 20%, to book the property. After that, you pay small monthly installments, often 1% per month during construction, and sometimes 0.5% per month, even after handover for several years. This model is offered by developers like Samana, and it is designed to make it easier for buyers to enter the market with less initial capital. The big advantage here is low early cash commitment. You are able to lock in a property at today's price without paying a large amount upfront. But here's the important catch. Under these schemes, you do not receive the title deed until the full payment is complete. This means that legally, you don't fully own the property until all installments are paid. So, you cannot mortgage it, refinance it, or sell it until the full payment term is over. Also, because you don't own the property outright, banks will not provide a loan on it during this phase. That's because in Dubai, banks need the official title deed to register the mortgage with the Dubai Land Department. Post-handover plans are not bank loans. They are private financing agreements directly between you and the developer. By law, your payments are kept in a RERA protected escrow account. 70% of those funds must go toward project construction. This adds a level of safety. But you are still dependent on the developer to complete the project on time and deliver the unit as promised. Now let's compare that with a traditional bank loan. When you take a mortgage from a UAE bank, you usually pay around 25% or more upfront, including registration and fees. The major benefit is you get the title deed immediately. You become the legal owner from day one, and the mortgage is officially registered with the Dubai Land Department. This gives you more flexibility. You can sell, rent, or refinance the property, depending on your agreement with the bank. And because it's a formal lending process, the ownership and financing are both secured under Dubai law. So what's better? If you are tight on upfront cash and confident about the developer, post-handover payment plans offer a smoother entry into the market. But if you want full ownership, legal flexibility, and better resale or rental potential, a bank loan backed by a mortgage is the better route. In fact, many experienced investors use a combination of both. They start with a post-handover plan to minimize early cash outflow and later shift to a mortgage once the property is ready and the title can be issued. Let's look at some real-life examples to understand how these payment strategies actually work. First, take the case of post-handover payment plan of Samana developers. Their popular 1% monthly plan means you pay about 42% of the property price over 3.5 years. That's 1% per month for 42 months before handover. After handover, you continue paying at 0.5% per month for another 4 years. This structure keeps your monthly payments low. For example, if you are buying a 1 million dirham apartment, which is approximately 2 crore 25 lakh rupees in Indian currency, your monthly payment starts at just 10,000 dirhams or around 2,25,000 rupees per month. However, keep in mind, you won't receive the title deed or legal ownership until all the installments are paid in full. Now let's take an example of a 50-50 payment plan. Suppose an Indian entrepreneur decides to buy a 1.2 million dirham apartment, roughly 2 crore 70 lakh rupees. The developer offers a 50-50 payment plan. The buyer pays 24% upfront, which includes the 4% Dubai land department fee. That comes to 2,88,000 dirhams or around 65 lakh rupees. This upfront amount covers the initial booking and government charges. The remaining 26% during construction, around 3,12,000 dirhams, is paid through the developer's milestone-based plan. At handover, the final 50%, that's 600,000 dirhams or nearly 1 crore 35 lakh rupees, is financed through a bank loan. Once the title deed is issued, the bank registers the mortgage. At an interest rate of 5%, the monthly EMI on 600,000 dirhams can be structured over a term of 20 to 25 years, depending on whether the interest is fixed or variable. Now, each situation is unique, so your strategy should align with your financial goals. If you have strong monthly cash flow, a larger down payment helps reduce your loan burden and total interest cost. But if your cash is tight, post-handover or developer-backed payment plans can bridge the gap. Just remember, these plans stretch over many years and you may end up paying more in the long run. Buying property in Dubai as a foreigner is absolutely doable if you plan carefully. You need to balance developer payment plans with bank mortgages, factor in upfront costs and fees, and prepare your documents in advance. So here's a quick summary. Choose a flexible payment plan that fits your cash flow. That could be a 50-50 plan, a 60-40 plan, or even a post-handover scheme, like the 1% monthly model. When it comes to loans, work with the banks that support non-resident buyers. Banks like Emirates, NBD, Mashreq, Dubai Islamic Bank, or HSBC all offer mortgage options for non-residents. Expect to contribute at least 24% of the property value upfront from your own funds. This includes the 4% Dubai land department fee and up to 50% of the funds before going for bank loan. Get your documents ready early. That includes your passport, visa if you have one, income tax returns, financial statements, and personal bank statements. A strong credit score will make your approval process smoother. Always aim for a mortgage pre-approval. Check that the developer is approved by your chosen bank. And don't forget to shop around for the best interest rates, whether fixed or variable. Use power of attorney if needed, and always work with a trusted local lawyer to protect your interests, especially if you won't be physically present during the transaction. We at Remax help you with this entire process, from selecting a profitable project, arranging bank loans, handling paperwork and registration, to offering post-handover support. We are present in almost all major cities across India, and Remax India has its own office in the UAE. Our goal is to make your property purchase journey in Dubai and other parts of the UAE as smooth and secure as possible. If you found this video helpful, make sure to subscribe for more Dubai real estate insights. Like this video and leave a comment below if you have any questions. Our team can also connect you with trusted mortgage advisors and real estate experts in Dubai who can help you make your investment journey smooth and secure. Thanks for watching and happy investing.